In this video, we will be discussing how the real way to make money with trading is not some crazy get-rich-quick scheme, but instead viewing it as a better investment opportunity. And really, most people who are actually successful with trading focus more on compounding while protecting capital as opposed to trying to flip accounts. So to start us off here, I wanted to actually show this quick quote from Albert Einstein. And Albert Einstein once said that compound interest is really the eighth wonder of the world. And essentially, he who understands it earns it, and he who doesn't pays for it. And anybody who has any sort of high-level knowledge of personal finance has probably seen some sort of materials on this in the past, whereas even a small investment can grow rapidly if you throw in compound interest and invest in anything that gives you a stable return, which is on top of inflation, and ideally compounds as quickly as possible. But all of this to say that what happens if we view trading not so much as some cash flow opportunity to make money fast, but instead as a way to really magnify our compound interest abilities to be able to really accelerate this process of the eighth wonder of the world. And I'm sure you guys have probably used something like this in the past, like a compound interest calculator. It's pretty commonly used when it comes down to just making a basic financial plan, where, for instance, like you would pick a certain amount that you can just invest monthly from your own savings, and then you would pick a number which essentially generally corresponds to the long-term return of the S&P 500, or if you're more conservative in your investment style, something which is more of a long-term return that you could see from bonds or from T-bills, for instance. However, what is really powerful is if we start to change what our annual return could be, we can see that the numbers here become pretty insane pretty quickly. So first I'll move my head and I'll actually run a few examples here. So let's pick a pretty modest example. Let's say we have $10,000 to invest and we're only making a $1,000 monthly contribution. And let's do this for 10 years. And granted, this is pretty short, not a huge amount of money, right? Like if you were a working professional in many more affluent countries, this would not be an out-of-the-blue investment portfolio for one to make. And here we can pick the long-term return of the S&P, so let's say 10%, and let's compound annually just to be conservative. And here we can see that in 10 years, we would have $217,000, which is quite impressive. And quite often when people will do something like this, they'll say like, oh, let's look at it over 40 years, like the classic like Dave Ramsey approach, and say, oh my God, in 40 years, you'll have $5.7 million. And this is really what many like personal financial gurus will tell you, or almost any financial advisor will tell you, that as long as you invest steadily and squirrel away a modest amount of money every month, over a long enough time horizon, you will do exceptionally well. But what happens if we now take this, but instead of kind of having a 10% annual interest rate, this number becomes quite a bit greater? And how are we going to accomplish that? We're going to accomplish this by using trading, but trading as an investment, not as a get-rich-quick scheme. So let's say we can be relatively conservative and shoot for anywhere between 3 to 5% a month through trading. And this would be algorithmic trading and building portfolio-based strategies. What happens if we keep the same $10,000 up front, $1,000 a month, 10 years, and instead of this being 10%, we make it 60%? Because this can be a very realistic return through using trading and through using leverage intelligently. And also to be like, technically you could compound daily with trading, but to be more conservative, let's say we're going to compound monthly, because you're going to have, like, there's a bit too much variance on a daily basis to use that number. So what does this look like? In 10 years now, instead of $217,000, we're going to have $10 million. So the $5 million, that was for 40 years, just as a reminder there. So here, in 10 years, we're going to have $10 million just by doing this, because we're going to be compounding our account massively. And then what happens if we take that same 40 years, and this is probably going to be unrealistic, but we're going to have an absolutely insane amount of money. Obviously, after 40 years, many of these strategies are probably not going to give you the same magnitude of return, just because like the absorption in the market is going to be different. But to be relatively conservative, let's say, let's go back 10 years here, compounded monthly, it's still a tremendous amount of money. So what does this show us? this shows us that really our focus here with trading should not be trying to flip a $1,000 account. That's not how you get rich with trading. You get rich with trading by making a good enough investment portfolio which can pretty much be safe, protect your capital, but compound at a rate which is quite a bit faster than the S&P 500. Let's say, for instance, we even were to make this 20% over the 40-year period, which we would have had $5 million in the S&P, but let's say we compound at 20% annually, we're now all of a sudden going to have $195 million, right? So that's the absolute power of, like, even if you just double the S&P, which is like easier said than done, you're still going to have an insane amount of money. So this goes to show that, like, obviously this is all easier said than done, but the real power here with trading is not trying to flip an account, it's trying to essentially make our annual returns better than they would be otherwise. So if you're more of a serious trader, a serious algo trader, your view shouldn't necessarily be to get rich quick overnight. You should be thinking like, okay, how do I beat the S&P by a wide margin? Because that's how you really get rich over a long period of time. But the most important thing to also note here is if you were running a crazy high-risk strategy where you could very well blow up your trading account, going back to trading, you probably would not be comfortable putting a sizable chunk of your savings, and I would never advise putting all of your savings in a trading account anyway, that would be rather silly, but let's assume that this is for a certain portion, like our high-risk bucket of savings. If this was running a risky strategy to generate this return, you would never put a sizable amount of money in there because, like, it doesn't matter how much money you have, you're probably not going to want to stick 200 grand into an account which can go boom at any time. You definitely don't want to probably put $1 million into an ultra high risk strategy. So to be able to get these returns here, which are just any sort of premium or multiple to the S&P or any sort of more conventional investment opportunity, you really need to be focused on the preservation of capital. So here I wanted to show another little table which shows what are the returns needed to recover from a market drawdown. And this was, I believe, used in the context of stocks, but the same thing holds true for any sort of drawdown. What we can see here is that if we have a 5% drawdown, you need to make around 5.26% to make it back. And this is logical, right? Like if you lose half your account, so 50% drawdown, you have to make 100% on the remainder. Like if you had $100, if you have $100 and you lost 50, you now have $50. To get back to $100, you have to make 100%, right? And this is why drawdown management is so important, because it's always a much harder battle to get back to where you started if your drawdown was too high, simply because of this mathematical effect. So what this shows is, in order to actually kind of shoot for this long-term compounding vehicle, to move my head again, I'll put my head over here, to shoot for this long-term compounding vehicle, we need to also be very mindful of our drawdown, because if our drawdown gets too massive, it's going to be extremely hard to actually get back to break even, because we're fighting math. So really, when it comes to trading strategies which are meant to compound, the most important thing to focus on is something which is safe enough that we're comfortable putting meaningful amounts of money in it, so that we're not treating it like fun money, we're treating it as a legitimate investment vehicle, and at the same time we're protecting our drawdown. Because if our drawdown gets too nasty, we're going to essentially need to make significantly more back in order just to break even. So really the summary here is that when devising a trading strategy, thinking of something which is more about the long-term performance and creating a vehicle which enables safe long-term but compounding at a premium, that's really the ultimate secret here. And that's what we're all trying to do. And at least with us as a company, that's our goal. That's what we're trying to build. We're trying to build portfolios which can enable that, because that's what really enables a long-term amount of value creation for ourselves as well for our clients. And coming to some examples here, like this quant analyzer portfolio, you can see that by stacking different types of trading strategies together in an account, building holistic portfolios of EAs, that's really the best way to do this. Because if you're trading manually, you can only do so many strategies at once. If you're trading with one EA, you're going to be too susceptible to market fluctuations. So it really comes down to how do we stack different EAs with a positive expected value to pretty much build a safe long-term compounding vehicle. And if you can do that, that's really the secret to really building significant wealth over time. So guys, overall, the focus of this video today is why compound interest and investments is really the most important thing you can do with your trading. Don't try and flip an account, try and sustainably compound, and you should be off to the races. So have yourself a wonderful day, and I hope you enjoyed the video.